Globally, long short strategies, uh, are distributed between a couple of categories. So what locally we call as arbitrage, that also sort of falls under long short funds globally. Then there is equity long short, which is one of the largest categories among hedge funds globally. There's something which is called managed futures, which is also very large and can also be put in a long short category. And then there is things like statistical arbitrage, which we in India know more as pair trades. So all of these are various different strategies which would fall under the long short category globally. Equity long short and managed futures are the largest uh, within long short globally, and these are both obviously the latest data is not always available on the categories, but an year or two back, both of these categories were about $500 billion each. So collectively, between a couple of the largest strategies within long short category, there is basically $1 trillion running across hedge funds globally. And obviously, each of these has their own pros and cons, has their own advantages. So a pure equity long short approach focuses on only the equity markets. And obviously, for global funds, it could be across many geographies or across many global markets. And while in India, in the category, there is a restriction on gross exposures by SEBI. Globally, in most jurisdictions, that is not there. So their uh, idea about equity long short globally is to keep low net exposures, while gross exposures could be high. So globally, it could be more than 2x, which is the limit in India. It could be 4x and 6x also, depending on the type of strategy. But when we say long short, obviously it means that we are going long some stocks and short some other stocks. So as a result of that, the net exposures can vary. Globally, within equity long short, there is a large segment which is long biased. So there the net exposures could be 30, 50, 70% also, despite being long and short. Whereas there is another category which is low net exposures where you could be 100 long, 90 short, and therefore be only 10% net short. Uh, so that varies a lot globally. It all started many decades back with more of the long bias, obviously from long equities. There was a transition to long short, and therefore the idea was to remain slightly long and still hedge a little bit or reduce the volatility a little bit by using some short exposures. But over time, obviously, more sophisticated strategies have come in, and therefore the net exposure ranges can be all across the 0 to 100% mark. And the type of strategies, as I mentioned, could vary across those different categories. So what I'll do is, I'll touch upon the two larger categories. As I said, equity long short and managed futures are the large ones globally. I'll also relate it slightly to what we are seeing in India as well, because not all of that is happening in India. Some of it has started getting traction, whereas for other things, there is a long way to go. So as I was saying, equity long short and managed futures within the long short category are the large hedge fund categories globally. In equity long short, again, as I was saying earlier, you can have low net exposures and high net exposures also. But the overall goal, if I was to summarize, is that the goal is to target lower volatility and lower drawdowns or lower losses than equity markets, while delivering similar returns or absolute returns. So that is how it becomes an advantage, because firstly, it is not long equities, it is long and short, and lower exposures, lower volatility, lower drawdowns. So what ends up happening is that the risk-adjusted returns are more attractive than just being long equities, and the risk becomes slightly lower depending on whether you are very low net or slightly higher net. But in both cases, the risk will be definitely lower than just being long equities. And then you are low correlation to other strategies, because in many periods where long equities is not doing well, some of these strategies would be doing well or not be faring as poorly, at least. So what that means is that it will be low correlated. So all of those are advantages. Uh, Disadvantages can be, obviously, some of these can become a little more complex to understand. The long and short side may be different. So you're long a different set of stocks, short a different set of stocks. So it's not necessarily an arbitrage kind of thing, and both sides could go wrong. So the risk management obviously is very important in all these strategies for the benefits to play out. The other thing is, of course, you can sort of play. Some simple examples are, on these equity long short strategies, you can play across sectoral moves and within sectoral moves. So you can have approaches that within the sector tries to take advantage of the lead and lag between movement and returns of the various stocks within a sector, right? So you can have a sector neutral approach, or go or keep shifting exposures between different stocks in the same sector and taking advantage of the dispersion within the stocks in the same sector. Similarly, you can take advantage of different sectoral moves. So you can have a sector rotation approach and try to latch on to the sectors that are more in favor, while either shorting the sectors that are not performing well, or at least staying away from those. So those are again various ways of and simple examples of doing equity long short. The other category, managed futures, which is very large globally, that is something which trades for global funds. They would trade across a lot of index futures globally, across asset classes. So they would do equities, fixed income, commodities, currencies, and then they would do that across geographies. So if it's equity indices, the large managed futures funds globally would trade, say, S&P futures, Nasdaq futures from the US, Euro stocks futures, and DAX and FTSE futures in Europe, and in Asia, Nikkei, Hang Seng, the Chinese futures, maybe the Indian futures, Nifty futures as well. So all of these, and then in currencies, they would trade all the liquid currency futures. So like this across all asset classes, across geographies. So it's a global approach, and it is very liquid because all these futures across asset classes are trade in large volumes. And then typically managed futures tries to capture momentum or trend following across different periodicities. So you could have funds that focus more on long-term trends, some which focus on medium-term trends, some which focus on short-term trends. Here, the advantage is that it is a directional exposure that you're taking, but you are changing that from long to short depending on what the signals are in the different instruments that you're trading. So again, you could be, long certain currencies, short some different currencies, long certain index future equity indices, short different equity indices, and therefore you are playing the momentum either up or down on these various instruments and asset classes. So the advantage here is that you can make strong returns in big falls in the either the market or the currency, or whatever asset class or instrument you're trading. So here you are not dependent on the things only going in one direction, but you can take advantage of large momentum in either direction, whether up or down. But the disadvantage is that you can have long periods when these instruments or markets go sideways, and there you will keep making small losses that may keep adding up. Obviously, these strategies are also non-correlated or lowly correlated to other strategies, including long short also. So they have a good I meant equity long short also. So they have a good advantage of combining within any portfolio, and they work very well in crisis periods. So in large falls in the market, typically managed future strategies have always done very well. So those are the advantages. But as I said, disadvantages are you can have long periods of small losses. You can get whipsawed on both long and short sides because you're going directional on both long and short sides. So there needs to be a balance, obviously. But these are the two categories, equity long short and managed futures, which are very large globally. As I said earlier, $500 billion in each of them, and that is data from a couple of years back. So I'm pretty sure that number could have grown. In India, relating it to what is happening in India. In India, managed futures is a very small segment. There are very few players, and the AUMs are very small right now because it is a little more complex to understand. Typically, systematic or quant teams can do these kind of strategies more. But on the equity long short side, there is some traction in India over the last few years, and largely in two sort of categories. One is the equity long short, where one is long biased. similar to a large percentage of the funds globally. So there you could be 50, 60, 70% net long, but you are using some hedging, some shorting of stocks to get either additional alpha or reduce the volatility or losses in your long bias portfolio. So that is one type of equity long short that is prevalent in India. The other is very interesting and has picked up a bit more than the first one, which is more focused on absolute returns, where you're trying to have very low net exposures, and there the net exposures vary from almost zero, which is what is globally called a market neutral approach, to small net exposures of 5, 10, or 20%. In most cases, not going above 20% net exposure to the market, and taking advantage of many different strategies of low risk and low net exposure to make returns, absolute returns, as the name suggests, over any rolling 6-month, 12-month period. So there, the category has started, replacing debt and debt plus allocations in investors' portfolio. So that is a category which has grown over the last few years more. But the first type of equity long short, the ones which could be long biased but are trying to make higher returns than equity markets with lower volatility and lower drawdowns, even that is picking up. So those are the two segments within equity long short that are now picking up in India. So there again, the answer would vary on depending on the type of strategy, because as I explained, both on the global and local side, equity long short obviously encompasses many different types of strategies. So the managed futures kind of momentum directional strategies, as I mentioned, those in fact have been the most consistent in delivering strong returns in all crisis events globally. So whether it was 2008, 2011, COVID 2020, or even earlier in the 90s and early 2000s, even the Nasdaq bust, dot-com bust, etc. So in all of those, the managed future strategies have been probably the only hedge fund category globally that have consistently done well in all those big crashes in the market. And therefore, there is a term called crisis alpha, which got associated with that category. And in the US, CME and other large institutions have also done a lot of research on it, which sort of shows that if you combine 20% of managed futures into your portfolio, then you are much more efficient on the efficient frontier. So it is a much more efficient portfolio, whatever your mix of equity and bonds may be in your portfolio currently. And obviously making money in those big crashes really helps from that perspective. So that category definitely has a big advantage, obviously because it goes directional. So assume even relating it to India, if that kind of a strategy would be net short on the Nifty or Bank Nifty index futures in large crashes. So obviously it would make strong returns. Then going to the equity long short category, as I mentioned, if it is a long bias strategy, then it will lose something. But whatever hedging you've done or whatever mitigation of exposures you've done by shorting some stocks or indices, that piece will obviously generate good returns in those crashes. So what it will do collectively is that it will reduce your losses in those kind of periods. It will not lose as much as equity, whereas overall that mix is trying to give you as good returns as equity or slightly better, but it's trying to do that with lesser volatility, lesser drawdowns than the equity markets. So that objective it will achieve, while it will obviously still lose something decent in those crashes. On the other side, the absolute return sort of category I mentioned. So there again, different strategies depending on the fund manager and the fund house vary. But either those strategies will make some very small losses or be flat, or there are some strategies which could make some small money. So obviously they will be the absolute return category will be the one which will totally insulate you from those crashes, meaning that it will be just another normal month for most of those funds, whether it's slightly down or flat or up. Typically, it will be just another month for those kind of strategies. So there, of course, you are getting an advantage of the diversification also in a big manner. So I would say absolute return and the managed futures, those are the sort of strategies within equity long short that would therefore help, although in very different ways. Absolute return is more dampening of the volatility and drawdowns, and managed futures is more for actually making positive returns in those periods. So different advantages, but those are the categories that would really help. Whereas equity long short would achieve its equity long short, which is long biased, would achieve its objective, of having lower losses and drawdowns than equity markets. But obviously, that strategy is meant to go up and down with the markets, but try to outperform on both sides. Correct. So definitely, that is the whole idea that I mentioned also earlier for both equity long short and managed futures, that their advantages are that they are lowly correlated to whatever equity funds, fixed income funds, or other alternative funds you may have in your portfolio as an investor. These strategies are typically non-correlated to them. Non-correlated meaning that they're doing well in periods that are different from all those strategies that you have. So therefore, having any allocation to these definitely makes the portfolio much more efficient on the efficient frontier, meaning that your risk reward of the entire portfolio becomes higher. So whether you allocate 5 or 10 or 20% to these kind of strategies, overall, when you look at do your portfolio analysis, because of that non-correlation, it helps in improving your risk-adjusted returns of your entire portfolio. So that is the big advantage. And why it achieves that is because typically a lot of these strategies like the absolute return funds and the managed futures, they try to be like all weather products, right? So when markets are going up or down or sideways, then a lot of these strategies try to make returns across these different market conditions using the very different strategies. And as a result of that, by being all weather, their risk adjusted returns become better. Their obviously overall risk becomes lower. And because of the non-correlation, because if you're making money in up, down, and sideways market, then basically what will end up happening is that you're positively correlated in the up markets, you're negatively correlated in the down markets, and again you're sort of zero correlated in the sideways markets. So as a result of that, again, when you do your portfolio analysis, then adding, like I said, 10 or 20% to these strategies will make you much more efficient on the efficient frontier, meaning that your entire risk-adjusted returns of your entire 100% will drastically improve. Those are the big advantages. So, for me, it has been more, I'm focused on systematic and quant-based approaches. And, I really believe in them because they bring a lot of discipline to the entire process. So I know, I mean, systematic and quant approaches are not necessarily feasible for everybody because it needs to sort of match one's own temperament. But I find that I've been more focused on these long short strategies, meaning equity long short, managed futures, absolute return at different points in time across these different long short strategies. And what I found is that marrying a long short and a quant, marrying long short focus of strategies with a quant approach is really helped over the last 2 decades overall and over the last 15 years on the buy side. The reason being that on the long short side, obviously you have uh, a very active and dynamic approach. Mostly you have daily or weekly or fortnightly, and at the longest sort of monthly signals that you're looking at. But there are more daily and weekly kind of signals. So it's very active and dynamic. You are going long and you are going short. So there are active decisions on both sides. And because you're going short also, so you're using futures and options. And the goal is to control your volatility or drawdowns. And all of that, what I found is that on a quant approach, firstly, your process is very disciplined, and you get a better sense of how performance can vary across different market conditions, which is very important for longevity. So obviously there will be patches and there will be surprises in any strategy in the markets, I think. So there is a saying globally among very experienced and the largest hedge fund managers globally, that your worst is always ahead of you, right? So whatever you may have seen, even though it's 20 years or 30 years, there can always be a period which is very different and much more troublesome than anything you've seen in the past. So you have to be sort of open-minded to that as well as sort of alert to that and be constantly thinking as to what can go wrong and therefore how will you be able to address it. So what I found is that those kind of things are much more, I wouldn't say very easy, but relatively easier to sort of quantify and keep thinking about and keep modeling when you're following a systematic or a quant approach. So from that angle, I find it interesting, and that is my whole reason of many years back going into the systematic and quant approach kind of field. And secondly, it leads to very efficient risk management. So again, simple stop losses and other things, many technical traders would have, but even more sophisticated risk modeling, like looking at VAR and even CVAR, which is sort of looking at the risk in the tail events. Those kind of things can be something that you can analyze very closely when you're following a systematic or a quant approach. And then more importantly, you can plug it back into your daily decisions and your portfolio management approach. Because you can say that if your CVAR is greater than a certain number, then you want to cut down your exposures. So those are things that I have found very useful over the last 15, 20 years in managing funds across different types of long short strategies and across different risk buckets, whether it is low risk or medium risk or high risk. And then, like I said, on the quant approach, you can keep avoiding a lot of psychological biases. So again, long time back, I felt I was better at research and thinking new ideas and thinking new models, but not necessarily the best in being, pulling the trigger fast as a discretionary trader. So again, if that is the mix of qualities that one has, then it is good to become more systematic and quant in your approach and avoid a lot of cognitive psychological biases that come in discretionary trading. And that helps get the discipline and the repeatability of your results also. And that is very important according to me. And finally, of course, you have to look at your comfort zone or your skill set or what you are better at. Even within quant, there are hundreds of things that one can do. You have to pick and choose what you're better at, as well as what you find more interesting to do. And then obviously work doesn't remain work. Your hobby and your work is sort of combined, and then you will enjoy your work as well as come out with much better ideas over time. And that will also help you not burn out, because sometimes trading or quant, managing quant funds can be high burnout kind of jobs. But if you marry what you're good at and what you enjoy doing, then obviously you will not have the burnout issues, and you can have much more longevity in your career or what you like doing. So that I think is very important as well on the softer side.